We're breaking down how to get affordable health insurance in 2026 with high deductibles that don't bankrupt you. I'm going to walk you through the exact framework we use to cut insurance costs by 40% while keeping real coverage. And here's the honest truth. High deductible plans aren't for everyone. But if you're healthy, run a business, or just tired of paying premiums you can't afford, this video is for you. No medical or financial advice here, just the steps thousands of families have used to make this decision work. A high deductible plan, or HDP, shifts costs to you upfront. Instead of paying $300 a month and hitting the doctor for a $25 copay, you pay maybe $150 a month, but you don't get help from insurance until you've paid $3,000 or $5,000 out of pocket. The trade-off? Lower monthly premiums. Most insurance companies now bundle these with health savings accounts, or HSAs, basically a tax-free pot of money you can roll into next year. The math only works if you're not at the doctor constantly. Step 1. Know where to buy. There are 3 main paths. First, healthcare.gov, the official government marketplace. It's free, it's transparent, and it's where most subsidies live. Second, private insurance brokers. They're free too. Insurers pay them commissions. Third, your employer. If you're self-employed or freelance, skip that one. We recommend starting with healthcare.gov because that's where the subsidies are. Run some quotes, then call a broker to see if they can beat it. Brokers sometimes know plans healthcare.gov doesn't display. Takes 20 minutes, could save you thousands. Step 2. Calculate your real total cost, not just the monthly premium. This is where most people make mistakes. A plan with a $150 premium and a $5,000 deductible isn't cheaper than $300 a month, with a $1,000 deductible if you visit the doctor once a year. Here's the math. Add the annual premium to what you'd realistically spend out of pocket. If you're healthy and go to the doctor twice a year, maybe your out-of-pocket is $400. Total cost, $1,800 plus premiums. Compare 3 plans side by side, same way. That number tells you the real answer. Step 3. Optimize your deductible. High deductibles usually come in tiers: $1,500, $2,500, $5,000, or $7,500 for family plans. Here's the pattern. A $1,500 deductible runs you $200 a month. A $5,000 deductible might be $120 a month. That $80 monthly savings is $960 a year. But if you hit the deductible, you're paying an extra $3,500 before insurance kicks in. So pick the deductible you can actually cover if you have an emergency. If you have $4,000 in savings, don't pick a $5,000 deductible. That defeats the purpose. The sweet spot for most people is $2,500 to $3,500. Step 4. Hunt for subsidies. If you earn under 400% of the federal poverty line, that's roughly $54,000 single, $110,000 family in 2026, you probably qualify for premium tax credits. These are free money the government gives you to lower your monthly bill. It's not a loan. You don't pay it back. Most people leave this on the table because they assume they don't qualify. Run the numbers on healthcare.gov. Answer the income questions honestly. The system will show you your estimated credits. Sometimes it's $50 a month. Sometimes it's $300. It completely changes your decision. Step 5. Once you've chosen a plan, minimize what you actually spend. First, use in-network doctors. Out-of-network costs can double or triple. Most insurers have a tool online. Search by zip code. Find in-network providers before you need them. Second, use generic medications when possible. Name brand Advil costs $15. Generic ibuprofen is 50 cents. Same drug. Third, Get prescriptions filled through mail order if your insurer offers it, usually 10 to 30% cheaper. And fourth, if you need a procedure, ask for the cash price up front. Sometimes paying out of pocket is cheaper than going through insurance for routine stuff like labs or imaging. Mistake 1, picking the cheapest plan without comparing deductibles and out-of-pocket maximums. Mistake 2, ignoring HSAs. Triple tax-advantaged accounts where contributions are deductible, growth is tax-free, and medical withdrawals are tax-free. That's free money. Mistake 3, not using in-network doctors or asking for cash prices on routine labs. Mistake 4, missing open enrollment deadlines. They're usually in November. If you miss them, you're uninsured for months, and re-enrollment costs extra. Set a calendar reminder for October. The mistakes are all about leaving money on the table or getting caught off guard. Do the work up front, and this saves you thousands. High deductible insurance is not the right move if you're chronically ill or take expensive medications. That's when lower deductibles make sense. But if you're generally healthy, manage your health proactively, and don't want to pay premiums you don't use, this framework works. We've helped dozens of families cut costs without sacrificing coverage. The key is doing the math honestly and understanding the trade-offs. If this helped, subscribe for more honest breakdowns on money, health, and family decisions. What questions do you have? Comment below and we will make a video about it.